Good morning. I think we're about ready to get started. Folks are still trickling in as far as joining the WebEx session. Glad to have everybody with us this morning for a Bankers Roundtable, Diversifying Your Small Business Lending. Please, you could join us. And this is brought to you by the FDIC, the OCC, and the Federal Reserve Banks of Dallas and Kansas City. We decided to put this session together just in regards to based on the needs that we were seeing out in the community and what we were hearing from financial institutions, some of the needs that they were seeing from the small business sector, what they were seeing, what they were feeling, and realizing with their financial institutions and other organizations that they were working with. So access to financial services basically is, as we know, is essential for education, business, home purchase, and so forth, and borrowing money on a fair and appropriate terms is very much at the heart of capitalism and a catalyst for the American dream. So those were remarks that were made by Esther George fairly recently in regards to looking at financial services and some of the opportunities that exist there. And then there's been some other information from former Chair Yellen, now at Treasury, in regards to the importance of lending products for small businesses. And, I'll quote as far as when it comes to the Hispanic community, there is such a frustrating irony in the historic data. On the one hand, this community outperforms in the creation of new businesses. On the other, you have less access to capital to create and grow them in the first place. One study looked at banks and their loan approval rates for white and Latino-owned firms. The approval rate for Latino-owned companies, was 60% lower, and that's even when controlling for how the business was performing. So we have a lot to cover. Those are just some of the highlights, and we're going to have quite a bit more. Let me, Alex, if you could move me to the next slide, please. So just kind of that disclosure, information, analysis, and conclusions set forth in this presentation represent the work of the authors. The agencies do not indicate concurrence by the Board of Governors of the Federal Reserve System, Federal Reserve Banks, FDIC, OCC, or their staff, or its board of directors. All right, I got that out of the way. Probably should have gotten that out earlier. So what are we covering today? As you saw in your registration information. So we're going to be covering the findings from the Federal Reserve Small Business Credit Survey with my colleague, Dr. Del Gines, in our Omaha office here with the Federal Reserve Bank of Kansas City. And then we're going to have a great panel that's going to be talking about supporting small businesses owned by people of color through capital and technical assistance. So again, we're talking about that capital side of things and the important technical assistance and how vital both of those are to assist our small businesses. So again, small businesses, as we know, and all of you are in this space more than I am, certainly how critical it is for a vibrant and a healthy economy. And my hope is that through today's session, you're going to have some takeaways in regards to how you can increase your efforts or what things you can put in place to assist these small businesses in your that you're seeing in your community. So how important this is to our overall economy, but that it gets down to the neighborhood level, the community level, and its impact. So I think pretty much next slide. That's me. All right, thank you. And with that, I think I'm just going to pass it on to Del. I'm Del Gines on the next slide, Alex. And I will remind folks at the end of the session, we are going to post an evaluation. So that's important for us, not only for today's session, but also for future sessions as far as what you'd like to see from us. And also post-event, we'll be sending you an email with links to all the resources that were covered today, along with other links from respective agencies, the OCC, the FDIC, Dallas Fed, and Kansas City Fed, et cetera. and all the presenters and so forth, so that you have that. So with that, I'm going to pass it on to Mr. Del Gines. Del, take it away.
Got it. Hey, good morning, everybody. It's good to see everybody virtually. It's glad that you don't have virtual fatigue. I don't know if like we started traveling, so I've been hitting the road for the last 5 weeks or so, being able to get out in front and see people. But I think, kind of these hybrid opportunities where some meetings are virtual, some are in person, are going to be the pathway going forward. And I think that gives us the broadest range of exposure that we could have. But seeing 126 on for what I think is a very critical topic of being able to, ensure that our diverse business owners have access to credit and capital is extremely critical for a variety of reasons. We have the significant demographic shifts, and like Ariel talked about, Black women and Latino women, at least from the 2002-2012 range, and I suspect when the new data comes out, we'll see something similar. We're the fastest growing group of business owners in the nation. Both of those groups, Latino and Black women, during that period, each created roughly 1 million businesses um, during that time. But again, the consistent research of undercapitalization and lack of access to things like credit capital, amongst other things within the entrepreneurial ecosystem, is a challenge, and we're going to need to solve some of those challenges to ensure that as the population demographics change in the United States over time, that we still have a robust economy that supports our communities, builds quality of life, and creates wealth at the community level. So, like Ario said, I'm his counterpart from the Omaha branch of the Kansas City Fed, and my primary responsibility is small business and economic development for us. And we're going to talk a little bit over the next few minutes about our system-wide small business credit survey. And so if you want to move to the next slide. So I don't know how familiar, I'm assuming because we probably have a lot of financial people, most of you are familiar with the Fed in general. But just for those that aren't, we have 12 regional banks, and then we have the Board of Governors out there in DC. And the regional function of the Fed is very important because banks need to be responsive. Well, at least this is the theory, which I happen to buy in. Banks need to be responsive to the needs of their local communities. And having a regional system where, let's say, all decisions aren't made on one of the coast, and we can be really sensitive to the needs of our populations, where those regional banks are, is vitally important. Esther George, our president, talks about it all the time. And we cover kind of the 7 middle states, if you will, or parts of the middle state, from pretty much Kansas City West, Nebraska, Kansas, Oklahoma, Wyoming, Colorado, and then pretty much New Mexico to up north. So we touch 7 states, all within in the middle of the country. And so we have unique economy within this particular region, a lot of ag, a lot of energy, and some other things. And so we need to be responsive to that. And so that's part of the Fed's responsibility. We conduct monetary policy, regulate banks, financial system work, and other things. But then you have our function, which I think is a great function because it allows us to really engage from the community development lens, are the communities that are and most often most in need, which tend to be rural. I do a lot of work in rural and urban distressed communities, BIPOC, people of color communities, and other groups that traditionally aren't having full or optimized access into our economic situation here in the United States. And to get behind this, you can move to the next slide. A couple of years ago, the Federal Reserve Bank system started doing an annual survey on the credit conditions across the United States. And the reason, because if you all know in this space, there's just not a lot of good data. Like you heard me mention that from the 2002 to 2012 period with Latina and Black women. Well, the reason that I referenced those particular time periods is because that's the last time the census did granular data down to the level in which we can look at what is actually happening with these populations. The census is trying to change. They have an annualized survey now that's only employer firms, but what we know is that 94 to 96% of all firms, especially firms owned by people of color, do not have any employees. So even in the surveys that the census currently has out there now, it's only focusing on businesses with employees. So we're really not getting good and robust data to be able to make decisions based around topics like we're talking about today. And so the Fed came in 2016 and said, we can't provide all of those primary research points and data points for folks, but what we can do is work across all 12 banks in the board of governors to come up with an annualized survey that digs into the credit conditions that are happening around the nation. You can move to the next slide. And so part of what I'm going to show you after I introduce you to the website is some of the high level data points that we can pull from this, and then talk about some of the other reports that are available. And so this is an actual screen cut of the small business page that we have. It's fedsmallbusiness.org. Ariel is going to send it out to you when he sends up a follow up with the links. But when you go on this site, what you will see is a wide variety of reports from the surveys that we've done in the past. There's reports on minority-owned firms, women-owned firms, rural firms, employer firms, non-employer firms, what happened to the pandemic, a whole plethora, if you will, of information, and you can even download Excel charts that actually have the data. Now, some of the challenges of this survey is it's what is called a convenience sample. So, and I'll talk about this when I circle back around and conclude the presentation, which is we rely on stakeholders to go out and submit the survey to their small businesses. So, there's that. And then if we don't get enough sample size within a given state, it's very difficult for us to make projections. And so you'll see, for example, we have data points for Colorado in the region as a whole, but not for some of the states that didn't get enough sample size for us to have a reliable data set. But I definitely encourage you to go on and check it out and just play around with it and look at some of the reports, especially being the fact that we're talking about how to fund diverse entrepreneurs now. We do have a lot of reports showing how their credit conditions have actually been affected over the years. Next slide, please. And so I want to start talking a little bit, and I don't have a lot of charts, and this isn't intended to be a really super duper deep dive into some of the data, but I think, kind of level setting what has been happening in the economy for all small businesses and then Kansas City region small businesses is really important since we're talking about the lending function. And while I didn't do a deep dive into any, minority or women-owned credit issues in this particular presentation as I've done in the past, what I do want you to understand is that for every high level data point, it's always worse for diverse borrowers and women borrowers. So I just want you to keep that. So what you see here is for all employer firms, and every data point that you see is almost always worse if it's a negative data point for borrowers of color. So the first one is kind of, this really is a vivid chart that kind of shows what happened during the pandemic, in which we are still not fully recovered from, as you know. So this is for what we found across the nation. And so you kind of see this trend of, showing this level of increase of pretty stable revenue between 50 to 56% of people that were surveyed from going back to 2016 said that they had an increase in revenue. By and large, the economy was doing, pretty decent. And you saw, not too many people say that it decreased, and it was actually on a declining trend pre-pandemic. You see it kind of said from 29% up to 22% that were surveyed said that their revenue actually decreased. But then you see the pandemic, and it whomped us out. I mean, it really did a number on our small businesses, as you all know, as lenders and people within this space. And only 14% in the 2020 survey said that their revenue increased, with 77% said they decreased. So one thing I want to communicate to you about this particular slide is that we cannot understate the challenges that the pandemic caused on our businesses in whole, as a collective community. Some did well, as you're going to see, but a whole lot of them are still trying to figure out or reposition themselves. And this disproportionately, impacted borrowers of color and business owners of color. And so then finally in the 2021 survey, which we do the survey roughly between probably I would say August and December every year. So you're looking at people responding near the tail end of last year. We see signs of optimism. We see signs of growth. 38% rebounded back and said that they expected that they had an increase in their revenue, which is a positive sign. But we still have a long way to go. Next slide, please. And so employer firm revenues, employment lag pre-pandemic levels. And so when you kind of take a look at this chart, what you're really seeing is that this is a 2-year window going back to 2019 up through to into 2019 through into 2021. And so and to me, this is positive. It shows that our businesses, by and large, care about their employees because while 27% said their revenue increased and 20% said their employment base increased, it actually 63% showed that during that 2 year window that their revenue decreased and they showed a decline, but only 43% showed a decrease in their employee base. And so what this showed me is that employers were really trying to keep their employee base. They didn't want to just throw them out into the wind by and large. We know that certain firms had to do that, certain small businesses had to do that. But what I see when I see this chart is if you have a revenue decrease that's 20% higher than the loss of your employees, they were really trying to retain their employee base. And I said that does say something about, our small employer-owned firms is that, they value their employees, they saw them as a resource and an asset, and they did the best they could to try to hold on to them by and large. Next slide. And so, more than two-thirds of employer firms had difficulty filling positions. This is something I'm sure you've all heard, and we hear it every day at the Fed. The challenges of finding, quality workers. And so, this is at the end of last year, so relatively, recent. In 2018, only 27% of the respondents said that they had a difficulty finding employees, and 27% said it was somewhat difficult, so roughly about 54%, and that's still no small number. Back in 2018 we saw that employers, over half of them, were still kind of struggling to kind of find employees. But now, post-pandemic 2021, you look at these numbers and it's skyrocketed. So 68% of our respondents said that they had a difficult time and are having a difficult time finding workers. And there's a lot of reasons for this. Esther George our president has done some great conversations on it. I'm not going to get into it in fullness, but some of it has to do with people retiring during the pandemic. And the interesting thing is she talks about the churn of retiring. Like when people say they retire, they often come back into the labor market in different ways. And she said they're not seeing that. We're not seeing that now. Also, we've heard a lot of challenges with caregivers, particularly women in the marketplace that historically were in the labor market, that through the pandemic went back to take care of their loved ones or their family members, either seniors or the babies, and they have not yet come back into the labor market. So there's a lot of tension that needs to be resolved, and we do need to consider this because as our small businesses grow, particularly small business of color, they're dealing within this environment as well. So while we're thinking about capital, we also have to think about helping them understand from a TA side, technical assistance side, how to be able to really manage this process of navigating a very challenging employee environment. Next slide. And so I'm going to drill down a little bit more into the Kansas City Fed region. Now, we do have data specific to Colorado, but since this is more within Wyoming and New Mexico as well, I wanted to kind of zoom out. But if you want to see if your state has data available, go back to Fed, smallbusiness.org, and you can click on the tab, and if there's an Excel sheet that kind of shows each state that was able to have enough sample size to be able to have a full breakout report. But we'll go with Kansas City now because I think we're getting at some of the similar stuff. Next slide. And so in 2021, pretty much 54% of all respondents said that their financial position was either fair or poor. And fair sounds, okay, but when you look at it on the spectrum of all the questions there, and those two bottom questions are the folks that are saying, either it's really poor, 1 out of 5, or like it's really poor, it's not going too well right now. And some are like, we're making it happen, but it's not really, that great right now. And so that's something that we do have to consider with our small businesses, is that things have not recovered yet. We are not out of the water yet, that there's still a pandemic lag that we're going to have to really, address through our technical assistance, through our entrepreneurship ecosystems, chambers of commerce, through our bankers, lenders. This is an all hands on deck thing. I guess if I could communicate to anything to you all, is that there's no one single source or institution or field that's going to be able to really help revitalize our small businesses. We all have to work in tandem and figure out how we can do this together, especially when it comes to our BIPOC entrepreneurs and low to moderate income entrepreneurs who need an extra level of resourcing from a technical assistance, capitalization, and community support side. Next slide. And so some of the financial challenges that were identified in the prior 12 months, and I think those of you who really think about it will probably could have predicted some of these, is about 1 out of 3 did say credit availability, and 14% said, we didn't really have anything. But the ones that were kind of the heavy hitters were operating expense, uneven cash flows, and weak sales. And when you look at, because I'm a former banker as well. I was a business banker at Wells Fargo and a way back in my prior life. So when you kind of look at the function of weak sales and uneven cash flow, they kind of go hand in hand. And so this kind of makes sense if you think about it, because while the economy has been rebounding, if you're looking at that 12-month window between January of 2021, or if we gave the survey, let's say in July, they're looking back at that 12-month window before that to 2020, they were still dealing with the vicissitudes, the ups and downs of the pandemic. Are we open? Are we closed? Is there a new variant? Are we going to mask up? Are people going to be scared? And so the impact on cash flow and sales makes sense. And of course, with that, if you have uneven cash flow and weak sales, you're going to probably have some problems trying, paying your operating expenses. Next slide. And so this is an interesting slide. At least I thought it was interesting because it talks about the responses that were taken in relation to financial challenges. And 15% said they cut staff hours and or downsized operations, which makes sense. But if we go back to the previous chart, which is at a national level, but I think it's reflected at a regional level too, this was kind of like cutting staff was a last resort. So my hypothesis is that while it showed that people didn't cut staff to the degree in which revenues declined, they probably did do a lot of hour reduction. They were probably trying to figure out the best ways possible to hang on to their employees. So they were trying to cut out hours to keep that employee so that the employee wasn't out in the wind and they can maintain the integrity of their operations to the degree possible. But some of the heavy hitters on this one were, obtain funds that do not have to be repaid. We had a lot of stimulus money coming down, EIDL, local funding, PPP, different things like that that have the potential to offset, some of the losses. And so it seems like we saw a big pickup for employer-owned firms on utilizing these resources that were provided. And that impact is dramatic because, with the level of sales as declining as possible, the ability for the government to come in at this particular time and provide some stimulus shows that probably a lot of businesses were saved because of that. But then half of them actually went to financial institutions to kind of bridge that gap as well. And then, of course, the use of reserves and the use of personal funds is to be expected. But, if you think about the personal funds usage, this probably has some impact, a long-term impact that we have not researched yet on, future retirement, what's going to happen if they used or liquidated a lot of their personal assets in the short run to survive the pandemic on their long run personal financial health of their household. That's just something that we probably need to consider, and it'll probably show up on your lender's books. The 3 forms of lending: cash flow, collateral, and then personal guarantee. If it's passed through that now they have diminishing assets, that may show up on the book somewhere when they come to get a loan. Next slide. In this slide, I kind of put 3 up there because they kind of are, talking a little bit about the same thing. But since 2019, again, this 2-year window, and I like the 2-year window because it kind of gives you a sense of a trend to the degree that you can. But 25% in the Kansas City region said that the revenue was higher, but 65%, almost 2 out of 3, said that their revenue was lower. And then, of course, 10-11 said flat. This has implications in lending as well, because if you're showing, as a historical cash flow lender, as most financial institutions are, you now have to figure out how are you going to lend to business owners who pre-pandemic were very viable. And you could look at their historical track record with their 3-year tax returns and kind of, do everything that you need to do in the weighting algorithms, financial, statement review. But now you're going to show a declining historical trend. How does that impact business borrowing going forward? Is something that traditional institutions are going to have to solve for and figure out how to do, and non-traditional institutions are going to have to take into account, like CDFIs. Revenue change prior to 12 months. Again, 51% showed a decrease with 11% no change. Revenue expectations in the next 12 months. And this is a cause for optimism. I think our business owners are starting to see a light at the end of the tunnel, because a full 60%, said that they believe that or are optimistic that their revenue will increase. And so there are, signs of life, signs of optimism, the looking at the light at the end of the tunnel. Next slide. And so here's where we as the Fed system really need your help. Now, as financial lenders, it's you probably can't, and it's not appropriate for you to send this out to the entrepreneurs in your portfolio. At least your traditional banking and financial institutions, your CDFIs, you all can. Your nonprofit lenders, non-traditional lenders, you probably can. But even for you banks, I know most if you're like, most of the bankers that I know, you're pretty connected with players within the community market space, local CDFI, small business support organizations, trade associations, things of that nature. There is a actual sign up link on the fedsmallbiz.org website that it would be really helpful if you could share it out. If you can't, distribute the survey to small businesses yourself through your network, send it out to folks that you know that you can. And this is why this is important. One, like I said, this is one of the only surveys out there that is annualized, that takes a consistent look across many lenses, from a diverse borrower perspective, from a women borrower perspective, from a size, from a geographic region perspective, where we can break it down to show that data every year. There's pretty much nothing else like this, to be honest, in the nation. But it's only as effective as, well, let me rephrase that. It becomes increasingly more effective the more businesses respond, for a variety of reasons, technical reasons that I'm not going to go into, but from a geographic reason, to the degree in which you can get more people responding in a geographic region, the better the data, and we can break out the data in different ways for you. So what I would ask is that if you have an opportunity, if you are CDFI type or others nonprofit lender, please sign up to be one of the distributors of the survey yourself to the small businesses in your network. If you're a traditional lender and it's not appropriate for you to do so, which is probably not, what I encourage you to do is just share the link to the Fed Small Biz website and say, hey, to the folks in your network that can, and say, hey, it would be really cool if we can get some great data on this from our region or our city or our state. Next slide. And finally, I just wanted to point out, as I'm near conclusion, some of the other stuff that I've worked on. Black Women Startups Report, if you're interested in what's going on with the fastest growing group of entrepreneurs in the nation, I wrote a report on that. We have a whole lot of guides on entrepreneurship ecosystem building, which is kind of my thing. The last thing we released is a partnership with Atlanta Fed, is a Small Business Owners of Color Recovery Guide, which does have some lending recommendations in it. So I encourage you to check that out. Next slide. And you can find that all on that link at the bottom, www.kansascityfed.org/community. And me and Ariel are here. We're a community resource. We only have jobs because of you. So we always encourage you to use us to the degree possible. If you have questions, don't hesitate to email us, ask us, and we are there to support you. That, I will turn it back over to Ariel.
Hey, Dal, thanks so much for that great presentation. Alex, would you mind going back a slide, please? So just some great resources. I want to make sure, and we'll make sure to include the links to Dell's page at the Kansas City Fed, but some great resources for you to use. And as you mentioned, some terrific tools that can help you with your lending. We have time for maybe a couple of questions. And don't forget, just as a reminder, to use your Q&A section over there. So for that, and Del, I'm going to kind of high level as far as high level takeaways for you in regards to the survey, especially as it relates to small businesses as far as owned by people of color. Was there some significant differentiation that you saw, or a takeaway that you can share with the audience?
It's so consistent. We have such a long road to go to make our entrepreneurship really equitable in the United States. Some of it is structural, meaning that, certain systems are in place, whether it's traditional regulatory lending, the way that we engage entrepreneurs, the way we socialize entrepreneurs. But when you look at the data, the most researched thing in small business as it relates to, BIPOC entrepreneurs is the issue of credit access. And the most consistent finding is that there's huge deficits between, white borrowers and non-white borrowers in terms of being able to access credit. Even there's even controlled studies that show, even when all of their other business performance metrics are the same. Their outcomes in the credit market are worse. And the Small Business Credit Survey and the reports that we've written in the past really do highlight the changes in that place. And so, and that's why I wanted to really get people over to the website, because we got so many really good reports that we wrote specific to, minority borrowing, regional borrowing, like different geographics, that can provide insight and help you understand maybe some of the ways that you need to structure your engagement with diverse borrowers to make sure there's more equitable outcomes.
That might be, and then what surprised me was on one of your slides, the financial challenges, only 30% was credit availability. I thought that might be would be a little higher than it was. So that was a surprise. But also the use of cash reserves and personal funds, that was surprising as well. So in regards to the findings. All right. Del Gines, thank you very much. Appreciate you being with us. And thank you. And I'll move it on. I'm going to pass it to my colleague, Kathy Holmes with the OCC. So Kathy and Alex, if you wouldn't mind going to the next slide, please. Kathy, take it away.
Thank you, Ariel. Hello, everyone, and thank you for joining us today. I'm Kathy Holmes, a Community Affairs Officer in the OCC's Western District. Small businesses, particularly those owned by people of color, often face barriers related to accessing the credit needs to start, operate, and grow their businesses. In July 2020, the OCC launched the Project REACH initiative. REACH stands for Roundtable for Economic Access and Change. Project REACH's mission is to promote greater access to capital and credit for minority and underserved populations. The project brings together leaders from the banking industry, technology firms, civil rights and community organizations, and other industries to address the policy and structural challenges that limit full and fair participation by underserved communities in the nation's banking system and economy. Project REACH's work is divided into 4 work streams, one of which is the access to capital for small and minority-owned businesses. The small business work stream also focuses on identifying the challenges of collateral requirements and transitioning entrepreneurs from utilizing consumer credit to small business financing. Additional information about Project REACH can be found on the OCC.gov website. Now, today's discussion will focus on the need for capital and technical assistance for small businesses owned by people of color. We're going to hear from an esteemed panel of speakers who will help us understand some of those specific needs and opportunities to enhance support of small business lending. I'm pleased to introduce our first panelist, Joyce Klein with the Aspen Institute.
Hi, Kathy, how are you? Can you hear me okay?
Thank you. Yes, we can hear you just fine.
Great, you just want to jump right in? Okay, terrific. Hi, everyone. And I'd like to, I'm glad to be here today, and I'd like to thank the FDIC and the OCC and the Federal Reserve Banks of Kansas City and Dallas for inviting me to be part of today's event. I direct the Business Ownership Initiative at the Aspen Institute. The Aspen Institute is a national nonprofit organization. We have a wide range of policy and leadership programs. My work is part of one of our policy programs, the Institute's Economic Opportunities Program, which focuses on advancing promising strategies, practices, and policies to help low and moderate income folks to connect to and thrive in our economy. And the work that I lead within that program focuses on expanding business ownership as a source of opportunity, economic opportunity in the U.S. Our work on business ownership has always focused on helping entrepreneurs who are the most excluded from accessing the capital, the connections, the markets, and other resources they need to start and grow businesses. But in the past 7 or 8 years, we've actually taken a very explicit and deliberate approach to focus on issues and challenges faced by business owners of color. So I'm really happy to be here today to share some of what we've been doing and learning. And if we could go to the next slide, please. So we work basically in 3 ways in our program at the Aspen Institute. First, we we both conduct research and we follow other research and data that gives us insights into the experiences of low-income business owners. And we do that with an explicit focus on race and also on gender. In terms of conducting our own research, we help CDFIs to survey their borrowers and clients to help understand their experiences over time. We also spend a lot of time following the research of others and looking at government data sets. And I just want to give a big shout out to the Small Business Credit Survey. It's been a huge tool and a really important and valuable tool for us as we're trying to understand what's happening for business owners of color. And as Del said, really important in sort of supplementing or stepping in for some of the census data sources that have not been routinely kept up. So we do that sort of research piece. Second, we work closely with CDFIs who are working to support entrepreneurs of color to help them to learn about and document the strategies and approaches that are working for them as they work to engage those entrepreneurs. And to give you just two examples of that, one is we have an ongoing initiative called the Microfinance Impact Collaborative, which is a collaboration that we organize and support among 6 of the nation's largest CDFI microlenders. About 75% of their borrowers each year are business owners of color. So they reach really deeply into that population. Another example is an evaluation we conducted of the San Francisco Entrepreneurs of Color Fund, which was a collaborative effort among 3 CDFIs in the Bay Area. So, and then the third thing that we do is we take what we've learned from our research and from our work in depth with CDFIs, and we work to try to share that information with other CDFIs, with funders and investors and policymakers to help spread that knowledge and the sort of practices that are most effective in reaching business owners of color and other low and moderate income entrepreneurs, and also in shaping policy so that it's more supportive of that. And we do some of that through our publications and our events. This slide shows you some of our recent work in this space, gives you a short link to our website where you can find this. Please check that out for more. And but what I'm going to do now, if we go to the next slide, is just give you a very brief survey or sort of summary of some of the things we've learned in our work. First of all, just to talk a little bit about, and again, we touched on some of these already, but what are the critical issues and factors affecting business owners of color, particularly as they go to access credit markets? I think we're all really understand the story that our nation faces in terms of the large racial wealth gap, which exists because of the very low wealth levels that we see on average for people of color in the US. I think we all know what exclusion from financial markets has meant in terms of lower credit scores or thin credit scores for people of color. Those sort of systemic structural practices and forces have put business owners of color in a place where they don't stack up particularly well against the 5 C's of credit, which lenders use to underwrite. So that is one of the challenges that we face in trying to think about how we try to get more access to business owners of color. The other thing that's really important to think about and to understand as we think about how we spread or increase access to color for BIPOC entrepreneurs in particular, and this is also very true of women, is the fact that their businesses are smaller. And this is, and one of the things you see when you look at trends in business ownership is that the firms owned by people of color, and particularly by women of color, are very heavily concentrated in low revenue, low margin industries, things like hospitality and caregiving, cleaning, construction, waste management, landscaping, transportation. And why is that? One of the reasons is that these industries tend to have lower barriers to entry. So if you can't access capital, you can't access much capital, they are firms that you can start because they don't have super intensive capital requirements. The other thing is that people tend to start businesses in industries where they have occupational or industry experiences. And so the fact that we have a history of occupational segregation, where women and people of color have been segregated into certain industries and occupations, also plays out in the businesses they start. So the impact of, I would say, occupational segregation is also key here and really important to understand. The next thing I wanted to talk about a little bit is how that, again, plays out in credit markets. So if we go to the next slide, we start to butt up against some sort of more market issues when then you think about how to drive capital to business owners of color. Because if firms owned by people of color are smaller and they also have less wealth and they have lower credit scores, it means that their ability to take on and service debt is therefore limited. And what that means is, the heading on the slide, is that small dollar business loans are really important in reaching this market. So just one of the things I want to highlight again, call out, this is the data on this slide is from the Small Business Credit Survey, for one of the studies that focuses specifically on business owners of color. And what you see is that about a quarter of Black and Latino-owned firms are looking for less than debt in amounts less than $25,000, and 2/3 of them generally are looking for loans less than $100,000. So they're looking for smaller dollar loans, and the challenge is, for those of you who are lenders, is that these loans are generally minimally profitable if you're talking at the high end, like close to $100,000, and unprofitable generally at the lower end. So the cost to acquire, originate, service these loans is generally greater, particularly on the very small end, than the revenues you generate from that lending. And it's why we've seen bank lending, in loans of that size diminishing since before the Great Recession. It's why the primary lenders who are trying to grow in this market are CDFIs, and often what you see, non-bank lenders who are generally, particularly as you get to higher risk levels or lower credit quality borrowers, offering products with very high interest rates to be able to cover those costs. So there's a bit of a math or an economics problem here when you think about doing loan lending to business owners of color. I'm going to skip, because I don't want to go too long. I'm going to skip the next slide. Can you go ahead 2 slides and talk briefly about something that we're doing in this space with some of our collaborative partners that I think will be of particular interest to bankers, which is that one of the things we've done with the members of our Microfinance Impact Collaborative to try to address this challenge of getting more CDFI micro lending out there so that we're doing more small dollar loans, even given their economics, is to create a new CDFI called the Entrepreneur Backed Assets Fund. What the fund is, we call it EBA fund, is creating a secondary market for CDFI microloans. So what we are doing through the CDFI is we're purchasing microloans from CDFIs and selling them via a participation structure with banks that want to acquire them to help them strengthen their performance against the CRA small business lending test. So there's a participation structure. The CDFIs continue to service the loans and to manage that customer relationship. But these are in large part loans in 2 businesses in LMI census tracts, 2 businesses with gross annual revenues less than $1 million. Through those transactions, we're able to generate liquidity for CDFIs. We also ask loans to provide, ask the bank acquirers to pay a premium, most of which we then donate back to the CDFI to give them support that they can use to cover the operating costs of originating new loans. We designed this with 6 of the largest CDFI microlenders. We now have 14 CDFI partners. We've purchased more than 1,000 loans. You can see some of the data here, totaling more than 11 million from 14 different CDFIs right now. I will note that we have CDFI partners, I think, in the regions that we're talking about that are represented on this call today. And our bank partners include Citywide Bank in Denver, which has purchased loans from us, as has CrossFirst Bank in Dallas. So that's a quick overview, and I will turn it back to Kathy.
Thank you so much. Our next speaker is Agnes Noonan with West. Hello, Agnes.
Good morning, everybody. Just quickly, WEST is an acronym, Women's Economic Self-Sufficiency Team. We were founded in 1989. We're a statewide nonprofit in New Mexico with a mission of serving women, people of color, and low-wealth New Mexicans who want to start or grow an existing business. We host 6 women's business centers throughout the state. We're an SBA microlender and a CDFI. So I think you could advance to in the next slide, please. So one of the next slide, one of the there were a lot of impacts of COVID, particularly during that first year, and we paid attention to many things that were happening, but I've listed here some things that certainly impacted the clients we serve. 36% drop in immigrant business ownership, over 40%, and that number might be higher if all Black businesses closed their businesses during the pandemic. In New Mexico, over a third, 36% of small and micro businesses closed their businesses after the first year of the pandemic. And research shows that it's taking women-owned businesses 3 times longer to recover. As we were going through that first year, even though we've operated a revolving loan fund since 1990, targeted to people who have difficulty accessing capital elsewhere, we ask ourselves, what more can we do? One of the kind of pieces of internal research we did, trying to understand when we have turned down someone, what are the primary reasons? And it won't be a surprise to many of you, but one of those answers was lack of capital. So next slide, please. That actually led us to start a new fund. We call it the Hope Fund, helping open opportunities for everyone. And it really was established to try to remove barriers to accessing capital for people of color and historically marginalized populations. As I said, that issue around lack of collateral for a loan kept popping up for some folks. So for us, we decided we raised about $500,000, and we continue to actively raise money for this fund. But the fund, will offer a no-fee loan, 0% interest, and a potential for the borrower to have up to 10% of the principal forgiven on an annual basis if they continue an active relationship with us. Part of that has to do with what we all know are the challenges in those first few years, particularly for startups. And we know that business owners will face challenges, and we want to be there to support them. So the only other, you do need to income qualify for a Hope Fund. So this is not for people with, wealth already. This is really targeted to people who do not come from family generational wealth. Next slide, just very quickly, this is a young man, Jordan Tate, who actually started working with West in 2019 to start a photography and digital media business. We spent quite a bit of time providing him some technical assistance, but it was that first year of the pandemic when he had an opportunity to significantly expand what he was doing, but he needed capital. He couldn't access capital anywhere else, and did have some issues, some credit issues, income, collateral issues. He was able to get a Hope loan. He was able to buy this drone photography equipment, become licensed in it, and then developed a very active portfolio and social media presence. Since then, since he got the Hope loan, Jordan has created 2 additional full-time positions. And I just love the last little part. Someone, a player from the Denver Broncos, found him through his social media presence, and he's now the official media partner for this player. The second initiative I wanted to tell you about, next slide, is a program that actually that got started in 2018 with support from the Kauffman Foundation. The focus was really on trying to address the financial challenges that diverse entrepreneurs face in their businesses. And over a 2-year period, we created the program, then piloted the program. It's really working with any business owner, whether it's the basics around, do you have a financial tracking system? If not, let's help you with that. Let's help you develop that, to whatever financial challenge they may be experiencing in their business. I think the model, from my perspective, resonates. If you're familiar at all with human-centered design, which is a part of the program model, human-centered design actually involves the very people you want to serve in helping to identify the solutions or the services to be offered. So in other words, it's not a static curriculum. It changes with each group that we're working with, but it does provide the opportunity to directly understand and address the needs that of whatever group is participating in a Money Learning Lab series. It's also mobile, another huge issue around access. Many times, we offer something, whether it's a training or what have you, and invite people to come to where we are. We felt it was very important to develop a program that would go into neighborhoods, go into communities where people live and work, so that we are providing greater access. Services are also bilingual, huge issue in this state, as I know it is elsewhere. And finally, it's really a partnership-based model. We're working much more, I would say, in the last few years with many organizations around the state who serve the population that we also seek to serve. And we're partnering with them to address some of the needs of their clients. Next slide. And this is an example of what I'm talking about. This is a home-based childcare accelerator initiative here in Albuquerque. We're partnered with a couple of entities, Partnership for Community Action, Growing Up New Mexico. The clients were 60 female home-based childcare providers from around the state. Our other 2 partners are kind of focused on the childcare related training. We're focused on the financial and business training and consulting. And there's a lot of peer learning activities and opportunities because it's segmented by language preference and experience levels. So those are just a couple of the examples of what we are focused on, recognizing that the access to capital piece, for as long as I've been at West and for many more years than that, has been very, very, very difficult for diverse entrepreneurs to actually tap into capital, which is not predatory. So I think with that, I'll stop and turn it over to you, Kathy.
Thank you so much, Agnes. Next up is Alan Ramirez from the Colorado Enterprise Fund.
Thank you, Kathy. Good morning, everyone. Alan Ramirez with Colorado Enterprise Fund. I work as our Director of Lending. Colorado Enterprise Fund, we're also a community development financial institute. Essentially, we're a lender with that community development lens. So we're focusing on community benefits, small business loans, the job impact, and how overall that's helping serve not only entrepreneurship, but building community as well. As a nonprofit, we've been founded, we were founded over 40 years ago in 1976. As a CDFI, we're all certified by the U.S. Department of Treasury, so we do receive funds directly from the Treasury Department. We are also an SBA micro lender, and various banks and foundations invest in our fund as well. We focus on really lower income and moderate income individuals. And so we were founded essentially by banking organizations that identified early on in the 70s, pre-credit reports, that there was a segment of the market that was not gaining access to these loans, and how could we help them? So since that time, CEF has been focused on specifically helping these underserved businesses. Just as a quick snapshot, some of the impact that we had just last year, we closed over 62 million in loans, did almost 1,600 loans total. 34 million was PPP alone, and our average size loan was 26,000. So it gives you some context in terms of who we are helping. We actually also transitioned into grant during COVID and administered over $19 million and deployed that to the community as well. And then our standard loan program did just under 9 million for the year. As a whole, 52% of our businesses are low income, 35% are minority owned, and 62% are startup businesses. 12% are veteran owned, and 42% are women owned. A big part of what we offer are definitely the loans. The loans can range as small as 1,000 and up to $1 million. But separate of the loans, a big part of what we offer is the technical assistance, the coaching, right? So one part of the challenge for businesses is just finding the access to capital. But secondly, it's how are you prepared not only to receive the access to capital, but really operate that business to a point of self-sufficiency or where you are bankable. So our coaching services start with financial literacy and accounting. We have QuickBooks specialists to help our businesses if they don't have QuickBooks. We also have accountants to help them with their numbers as well, maybe transitioning from a sole prop to a C Corp, things like that. We look at their marketing. What is their social media? Do they have a website? Right now, we've got a program where if customers are only visible via social media, we can help design a website for them for free, cover those services for the first year as well. We look at operations, how they're hiring, what employee handbooks they might have, how they're training, overall, if they're working with if contracts or different, maybe it's the airport, different cities and state government agencies. We have lawyers that can review those contracts for the businesses as well. And all these services are free of charge throughout the life of the loan for the customers. So again, the idea is, yes, helping them have access to the loan, but again, really helping them continue to grow and learn how to truly operate that business successfully. I would say some of the programs and initiatives that we're focused on, we've got a Black Business Loan Fund that we created almost 2 years ago now. It's an interest rate of a 2.99% with a 5-year term. We also can build in interest-only payments for that business as well, and those loans max out at $50,000. But we created something similar as well for businesses that don't operate with a social security number, but do operate with a tax ID number, so ITINs. And with that program, similar, 2.99% over 5 years, that loan is up to $25,000. Other initiatives that we're very focused on are access to healthy foods. So anything relative to the food systems, whether it's distribution, whether it's carnicerias, ethnic grocery stores, standard grocery stores. We're attempting to provide access to healthy foods, both in rural and metropolitan areas. And lastly, we also have a veteran program, Valor, specifically targeted to veteran-owned businesses, also with discounted rates and fees. The last thing I'll leave you with is that we also have place-based initiatives. So we manage currently 7 different loan funds throughout the Denver metro area. And so for different cities and again, state agencies, we'll manage loan funds that are specifically targeted to those communities. And again, generally those are discounted rates and discounted fees, but it's it's building that community. It's building more economic vitality in those areas and creating a lot of businesses. And so overall, I would encourage you all, if you don't work with CDFIs, to please research that for yourselves to see what CDFIs are in your community. But I think generally we're lenders that are looking at underwriting with a more flexible credit box and criteria and very targeted, again, to these LMI communities. So I look forward to the panel and answering any questions that you may have for me. Thanks.
Thank you, Alan. And finally, we have Brandon Willis from U.S. Bank.
Hey, Brandon Willis, U.S. Bank Business Access Advisor. I am here to talk about our business access commitment. It's a $116 million commitment by the bank to accomplish three things. One, greater access to capital for families and communities of color. Two, greater access to capital for business owners of color. And three, greater opportunities for minority employees. Access commitment, as you look at the slide, we're looking to accomplish a great deal of things. We're sending people to leadership summits, McKinsey Leadership Academy, in order to better train our minority employees. We're doing supplier diversity. We have a supplier diversity initiative that is looking to double our diverse suppliers. Some of these slides will show Black first, and that is intentional because the racial wealth gap with Black businesses and families is the greatest. But this commitment, this program is for the benefit of all businesses and communities of color. As we move to the next slide, we know that there's a lot we need to do in our own house, and this is covering the opportunity, as I see it, for serving diverse customers within the bank, and I'm sure this applies to all of us. So if we start by taking care of our own house, we can do a tremendous amount of work before we even step into the community. But that is the point there. Next slide. The ultimate goal of this is twofold, really, to close that racial wealth gap. As you can see, we do that and we increase GDP 6%. That's pretty big in this day and age if we can accomplish that. We also want to create over 100,000 jobs. If we do that, we're also closing that racial wealth gap and helping achieve our goal. Next slide. As you can see, this was launched in February, starting with the Black community, again, because of the vast difference in wealth between Black families and community and business and others. But we'll soon have business access advisors like myself that are catering to and serving all communities of color. Next slide, please. This is our pat on the back about the response that it's gotten, but I would apply to any bank that is doing that work, and there are other banks out there. And for today's purposes, I want to view us all less as competitors and more as bankers looking to achieve a common goal. And so, again, very proud of what U.S. Bank has done in the reception, but I'm also proud of other banks that are out there doing the same work to help us achieve that goal. Next slide, please. So again, as you can see here, those initiatives are workforce, supplier diversity, marketplace, and community. Next slide, and I'll get into a little bit more detail with that. Boy, I can't read that, but supplier diversity, again, doubling the amount of diverse suppliers is a lofty goal and one that I'm excited that we're working towards achieving. Next slide, please. Again, I would say we need to skip this next slide because I know we're tight on time. In the marketplace, and that's where it's important, we are funding partners like Alan, and knowing that immediately the bank can't do a lot of that access to capital work as quickly as our CDFI partners can. So we are pushing a lot of those dollars to CDFI to accomplish that. Where I come in is to be that relationship manager that engages with these businesses as they are working with the CDFI to help provide additional assistance so that they are more so that we can quickly make them traditionally bankable and stay with them throughout the process, which I think is something that banks haven't done by and large. Traditionally, what you'll see is banks have, to what Joyce and Agnes said, these are small segments that don't get a lot of attention from large banks. And so if they even get to a bank, the bank is quickly losing interest because it's not very profitable. What they're asking me to do is stay with those businesses regardless of size and profitability, and engage with them throughout the process, be a resource, send them to partners like Alan, like Joyce, and find capital however we can find them, giving them guidance, and then bringing them back to the bank when they're ready so that they can, again, achieve that ultimate goal of creating more jobs. I think that that photography company that Agnes mentioned is a perfect example of how this works in the right way, and we are looking to engage with as many of those types of businesses as we can. Our challenge is that, again, startups, certain sectors just aren't the best for coming to the bank initially. That's why we work with those partners and fund those CDFIs. Next slide, please. And then the micro business fund, again, we're very Accelerator fund, very proud of that. $20 million, $5 million for women. This is part of the good work, and really, I believe that's the last slide. Is there another slide, Kathy? No. Then I would say that, again, it's a lofty goal. We're trying to accomplish a lot of things. I am there to engage with and work with as many businesses of color as possible, and work with existing resources to make sure that these businesses have access to capital. Looking forward as well to panel question and answer session, and I will turn it back to my partners.
Thank you so much, Brandon. Small businesses are important. They're an important component of economic success and strong communities. They drive job creation and local and regional economic growth, and also provide opportunities to build household wealth. We've heard some factors and barriers affecting entrepreneurs of color. This question is for the entire panel. What is the greatest challenge your clients face in accessing capital? Please unmute.
I'll jump in. This is Brandon again. I'm sorry. I think we've covered it. It's lack of financial background, lack of capital initially is what comes up again and again in our own internal due diligence. And then a greater problem is that there's some skepticism with clients about how banks have performed in community in the past, and I think that's rightfully earned. So there, to what Dale said earlier, there's a lot of work to do. They've seen initiatives come and go, and they've seen banks fail, and so there's a lot of work to regain credibility in the community. And with that, in addition to the lack of financial expertise and capital, that's probably the two biggest factors for me that I'm seeing.
Kathy, if I might just build on that a little bit, I might flip it a little bit. I mean, so we've talked a lot about what some of the barriers are. What we've seen in some of the lenders that have been able to significantly scale their lending, these are CDFIs, to business owners of color, it's been the willingness, as I mentioned before, to make smaller loans, and to do that by de-emphasizing collateral and looking very flexibly and closely at credit history, not just credit score, and focusing more on cash flow and ability to service debt. So what you're saying is, like, if folks don't have collateral, we're going to de-emphasize this. We're going to figure out ways to manage our risk that's more focused on their ability to generate the revenues and manage their cash to be able to service the debt, and that will allow us to increase our lending.
And also, to everyone, how does technical assistance help to address some of these barriers?
You know, I'll take that one. I'm sure others want to comment as well. Several years ago, the Association for Enterprise Opportunity did a great report on kind of the role of micro business in the United States. Doesn't always get the respect it deserves, and typically that's 5 or fewer employees. But they reported that over half of all micro business owners in the United States have no more than a high school degree, if that. So, when we talk about this topic of capital and, we see it day in and day out, I think it really requires organizations that are providing technical support, whether that's training, one-on-one consulting, to acknowledge that, you really have to know who you're working with and where they're coming from, what they may or may not have learned in school. We're all aware there's a huge financial literacy gap across the country on both the personal and business side. So I think that, in fact, when you ask the question about the greatest barrier to accessing capital, part of my response, in addition to what was already mentioned, is the lack of knowledge about business and finance. I mean, people have great ideas, but frequently they don't know how to execute on them. And that requires a lot of foundational work. And, it's one of the reasons we don't use a credit score as a determinant whether somebody gets a loan or not. Every situation is different. And one of the, things we have seen on credit reports over the years, which I think is a growing issue, is the amount of healthcare related debt on people's credit reports, which then sometimes they're aware of it, sometimes they're not. But we all know there are issues in the healthcare industry. So I'm just suggesting that it's got to be the recognition and the willingness to really help build that business and financial capacity and knowledge.
Thank you so much. Yes, Alan?
Yeah, if I could just add on to that, I also think it's key. Along those lines, we deal with a lot of immigrants. And I think in the traditional lending space, a business plan is needed, projections are needed, which makes a lot of sense. But someone coming that is new to this country, attempting to write that business plan in another language, one can be challenging. The structure and understanding cash flows is another challenge too. So for us on the business plan side, we've got different templates based on the loan amount that we provide to those business owners to complete. Some of them are almost in a questionnaire format, so that it's more so the questions are there for them to answer, but it's still dealing with how are they marketing, who are their competitors, and we're still pulling out the details that we need to feel comfortable with that deal. But it's not so much are they able to write the business plan. It's really, do they have the understanding and the knowledge to execute their experience. And so I think as a CDFI, similar to what Agnes is saying, is it's not about just FICO scores. It's not just having the checklist items of what you need to underwrite the deal. It really is digging into the customer and understanding what's your background, what's your experience, what kind of team are you setting here, and do you have really the ability to execute this? So I think trying to be creative in some of those items that we're asking for has helped us quite a bit.
Thank you. Those are all great points. Leveraging partnerships to expand access to diverse types of capital and technical assistance resources are needed in order to support minority-owned small business, including partnering with key support organizations such as technical assistance providers and CDFIs, as already been mentioned. We are just about out of time, so let's take just a few minutes, and I want to find out if anyone on the panel would like to take this opportunity to add any further comments before we close.
Kathy, I'd love to, because I got a follow-up question I noticed in the Q&A, like what are examples of how a small business can prove they can manage and execute a loan? And one of the things I would note is that we see CDFI see business owners with all different levels of experience and history in operating a business. So there's folks who come in at startups, but if you are talking about a small business owner who may be an immigrant, who may have been operating a business for 4 or 5 years, who hasn't been able to access this, hasn't been accessed bank credit, for a variety of reasons, whether they don't have a credit profile or they don't have those relationships, or the loan is in a service industry and just isn't that attractive to a bank. There's lots of things you can look at. You can look at their bank statements if they have, and look at whether they're regularly depositing cash and resources and regularly covering their expenses. And that's how a lot of lenders, small business lenders, whether they're fintech or CDFIs, are underwriting now. Just like, what does that bank statement tell us about whether someone's generating revenues and whether they're able to manage their cash? What's their experience in the industry and how long have they been doing this for? How many customers do they have? Those are some factors that actually may not take that much time to actually dig into and can give you a sense of whether someone can actually service on that loan. It does differ a lot, whether they're a startup versus an existing businesses, but there are a lot of existing businesses out there that haven't been able to access bank credit or formal credit markets who do have a way of showing that they have the ability to manage debt.
Okay, well, thank you all for your insight on this important issue. I'll now turn it over to Gina.
Thank you all. What a wonderful presentation. I'm learning so much, and I hope that the rest of our audience is as well. I want to thank our panelists for doing such a wonderful job answering the questions in the Q&A, but there are a few stragglers that have not been answered yet. So there's one in particular that I'm interested in. So of course, I'm going to prioritize that one. And I would open this question up to all of our panelists as well as Dell. So Dell, I'm going to have to wake you up now. But Joanna is very interested in any models that you are aware of, and you guys have spoken about a few, but any additional ones for sharing how multiple technical assistance providers and capital providers work together in the same ecosystem to support and align missions versus duplicating those efforts or not addressing critical needs at all.
Right, Gina, I can jump in here a little bit. I mentioned that we did an evaluation of the San Francisco Entrepreneurs of Color Fund. And one of the things, this is more on the lending side, but that those CDFIs did when they partnered together and did a joint website, is they clearly differentiated the difference between who their borrowers were and what stage of businesses they served, and what size of businesses they were willing to lend to. And where that really helped business owners was that they didn't go to a website and say 3 different CDFIs and have to try to figure out like, who's going to make a loan to me? They could see that this CDFI focuses on early stage businesses and makes very small loans. And this CDFI works with businesses that have generally been in operation for a couple of years and makes loans between $50,000 and $250,000. And this CDFI actually does more equity-like investments, and they could route whatever equity was to the right CDFI. And I think that's one of the things that's really helpful is not only just not duplicating efforts, but making sure that the business owner doesn't have to do too much work to figure out what's the organization that's actually the right fit for them and is going to get them the help they need quickly. Because I think everyone knows how busy small business owners are.
Thank you. I think in any initiative or any opportunity, a gap that you're trying to address, is just inventorying what's there and making it less complicated for either consumers or small business owners to navigate is very helpful. So absolutely, I would consider that a best practice for sure. I have a question. And this is for you, Alan, specifically. And then Philip wants to know, why are interest-only payments an option for the Black Business Loan Fund?
62% of our businesses are startups. And so oftentimes as they're ramping up and developing their market, that interest only period, if it's an option to them, if they choose to take it, but it's just an opportunity for them to have a reduced payment before jumping into that full principal and interest payment. So just an opportunity to help them grow without taking the burden of the full debt payment immediately.
And Gina, we actually use interest only even at other stages of loan repayment. If the business is facing a particularly challenging time, then we may revert for 6 months to an interest only scenario so that they're not saddled with continuing to, have to make that loan payment.
And I might jump in as well to say that right on this call today are good guys, but there are alternative lenders that are, I'm seeing this more and more every day, where these clients are coming to me and they're getting into loans that they can't afford to pay. So this interest only gets them an opportunity to dig back out, but there's some predators out there, and so it's great that we have some options here for interest only or for things that aren't going to put them at a disadvantage financially. So again, I highly encourage everybody on the call to find a CDFI, begin that relationship, and help steer these clients to the good guys.
Thank you. Thank you. Glad that question initiated some additional dialogue. Very good question. Thank you, Philip. Noah is curious to hear from the panelists about any initiatives for diversifying lending by addressing the silver tsunami. So I think we all know that term. I won't define it, but many small business owners are seeking to retire and looking to sell their business to their employees. So it's a great avenue to retain jobs and close the racial wealth gap through employee ownership. So any best practices or initiatives that you are aware of? It's definitely an issue.
Gina, I just sent I tried to respond in the Q&A with a link, I think. I don't know if it came through. I'll try it again if it didn't. We've done some work on this issue. One thing I will note is that there is some work that needs to be done from a policy perspective on this, because, for example, some of the lending tools, for example, some of the SBA programs make it challenging to do financing to employee-owned firms. For example, if you require personal guarantees, it becomes an issue if you're selling to multiple owners. If someone's certified as a minority-owned business or a women-owned business, and then you have a more diverse corporate structure, you can lose that certification. So it's a really great idea and something that's really important to think about. But it's also a bit of a challenge because there are some financing hurdles to help those transitions take place.
Probably some of the same hurdles that we've been talking about today. Yes. So you guys are doing a great job answering the questions in the chat. I just want to let the audience know that these panelists and Dale will stay on for a few minutes. And if you have any more Q&As, we'll make sure and look through those and answer them as they come up. But I'm going to take the liberty of asking the last question. So, most of our audience are bankers, or they are organizations like yourselves looking to work with bankers. And so if you had to summarize one key way that bankers could partner with you to meet the capital access needs of small businesses owned by people of color, what would that one first step be?
Pick up the phone and give me a call. I'm looking to help as many as we can. I am available through LinkedIn. I'm not the one-stop all, but I will be happy to make an introduction where my bank is not the best fit for the client, and I will always do what's right for the client. So if that's not with us, we'll find another place for them to get this funding.
You know, we get a lot of great support from banks in New Mexico, and we're very grateful for that. There's always room for new relationships. I think, you know, for me, it's an ongoing educational process, whether we're talking about our bank or other funders, for them to understand the barriers that a lot of the clients that we serve are facing. And it's not just a matter of they can't make the loan, so you make the loan, because it's just not as simple as that. So, and we also, I think, always are trying to identify ways in which bank personnel, depending on their level of background and experience, because we do so much work in the financial area, opportunities for them to interface with our clients as we're trying to build their capacity.
Thank you. Alan, would you like to chime in?
Yes, just quickly. The path to capital, I think for entrepreneurs, it's, you know, they're looking at their own savings, credit cards, we know they access, and friends and family, et cetera. But eventually they always end up at the banks, or generally a good portion of them will end up at banks. Banks don't like to say no, but sometimes they're going to have to. And I just think an easy handoff would be to really understand what resources are in your community to support small businesses. It's got to be a revolving door in the sense that explain to the customer why they're not bankable. Identify specifically what are the needs, where are the weaknesses. You know, some of these businesses don't quite get the C's of credit or even know what that is. And for us to take a minute to explain those C's of credit to them and where they can go to kind of build some of those items, I think is significant. So here in Colorado, we're happy to take those that you can't help and try to keep that door revolving for that small business, whether it's working with the SPCs or SCORE, other organizations. But we need to keep the door revolving. It can't just be a hard no, and that business owner's done. So,
Thank
Gina,
you.
I would note that I mentioned during my presentation the new CDFI we've created called ebafund.org. So if banks are interested, I mean, what's I think innovative about EBA Fund is that it provides a way for banks to partner with CDFIs in ways that not just help support their performance on the investment test, but actually gets them lending test credit, which is often a struggle, particularly for smaller banks and community banks that, for example, don't have a business credit card. And so would just encourage them to reach out if they'd like to partner with the CDFIs we work with. And I just chatted out our link if they want to learn more.
I wrote that one down myself, so thank you. All right, so with that, we've run out of time and used some of Mayor Cruz's time, so I will turn it over to you for closing remarks.
Yes, thank you. Thank you, Gina. I'm Maricruz de Leon with the Dallas Fed, and we do want to make sure that we wrap up on time, but just wanted to give a few thank yous. First of all, a thank you to our guest speakers, to Del, to Joyce, Agnes, Alan, and Brandon. Thank you so much for sharing your time and your knowledge with us today. We really appreciate it. Second, thank you to our attendees. We hope this information was beneficial to you. We hope that you take some of this back to your communities. And we do want to ask something of you. Of course, your information, your feedback is very valuable to us. So if you look on the right-hand side of your screen, you should see a poll. That's an evaluation. We do want to hear what you thought about the event and just share your thoughts with us. So please, please, please answer those questions before you log off today. And finally, a big thank you to my colleagues, to Gina Vincent at the FDIC, Kathy Holmes at the OCC, Ariel Cisneros and his colleagues at the Kansas City Fed. Thank you for making this event possible. And with that, we'll go ahead and close. Thank you all for attending. And again, please provide us your feedback on the poll. And you all go out and have a great day. Thank you.